information can be both correct and damaging, because if you act on correct information, often it can cause you damage to your portfolio, to your business, whatever it is. And that comes from what Kahneman did in some work that he did about a sperm and egg analogy. Often the information we get is only the first part of the information we need to make wise decisions. And what we're going to do in this webinar is we're going to look at 8 of these sperm and eggs. In actual fact, I know there are often people who love double checking everything that we say, which is fantastic. When you do that, some of you will probably decide I'll talk about 8, some will say 9, and some will say 10. I've counted them as 8, but you could argue that it's really 9. You could argue that it's really 10. I don't think it really makes terribly much difference. We're going to look at a lot of sperm and egg situations where in this COVID and lockdown period, our decision-making is probably being compromised by taking that first bit of information. For those of you who don't know the sperm and egg analogy that Kahneman talks about, what he points out is that when a sperm hits an egg, all other sperms there afterwards are rejected. Only one sperm normally gets to the egg. Now, I'm told by my wife that occasionally it can be 2, but generally only 1. And in other words, what we're really saying here is these are decisions we make because the first piece of information we hear fertilizes our egg, so to speak, in our brain, and thereafter we don't look at all the other information. We only look at that information. So let's take the very first one among them. Josh Frydenberg pointed out that the economy is losing $4 billion a week. And that's actually his phrase. The economy is losing $4 billion a week. And watching my television and reading my newspapers, or they're no longer in print, but online newspapers, everybody referred to this expression, the economy is losing $4 billion a week. Factually, in a way, that's true. But if we look a little bit deeper to that in terms of how it's affecting people and how it's affecting spending, what has really happened is, yes, the economy is $4 billion a week smaller, but the government is transferring something over $200 billion to businesses and the population. So in actual fact, there's a huge amount of money going into the spending parts of the population. Yes, it's raising debt for the future and meaning our children and our grandchildren are going to be worse off because they have to pay off the debt or pay interest on the debt even if they never pay it off. But in actual fact, the working parts of the economy, individual spending by businesses, by individuals in society is not losing, in fact, $4 billion. On top of the $200 billion that's coming from government, people are able to withdraw $10,000 from their super before the 30th of June and again after the 30th of June. If there's 2 people in the same household, that may mean they can draw $20,000 each. And that, looking at the numbers and the way they're rising, that looks like it's going to be about another 15 billion before the 30th of June, and possibly, I'm guessing here, maybe another 30 billion after the 30th of June. On top of that, banks have already taken $200 billion worth of loans and said no repayments currently due on those loans. Now, I don't think the banks are doing anybody any great favor, because in the end, all this money will have to be repaid by people who owe the banks or companies that owe the banks. But at present, money that would have been going out of companies, going out of individuals' pockets, is in fact not going out to the same extent to the tune of the repayments that would have been on that $200 billion. Also, landlords, in some cases, are not receiving payments from the companies that are renting from them or the individuals that are renting from them. Now, that's a net zero because somebody else is not getting the money in the economy while somebody is getting the benefit of it. But I think the overall thing that I'm saying with this is if we just say to ourselves, the economy is losing $4 billion a week, that's a lot of money. We would say to ourselves, if that's the case, I mean, our economy is only 1.3 trillion anyway. So if it's losing 4 billion a week, that's around about 210 billion out of 1.4 trillion. That's about a seventh, 14% of the economy. We could get in a real tiz and say the economy is in such a disastrous mess that I should be not investing at all. I shouldn't be trying to build my business. I should be hunkering down and doing nothing. Now, of course, if you hunker down and do nothing, you turn your own business or your own portfolio into a recessed business or a recessed portfolio. Nothing brings on a depression faster than everybody hunkering down and doing nothing. So that's the first one. Now, just a last point perhaps on that one, just looking at my notes again, is people at home spend less when they're at work. Hence, not surprisingly, they've got more disposable income, assuming the income's the same. They've got more disposable income. We've talked about this before, by staying home than by going to work. And interestingly, Breville, for those of you who didn't see it, Breville had an announcement yesterday, late in the afternoon, about their results over the, 10 months of the 12 months of the year, showing rapid growth in revenue and profits, particularly also, or most interesting to me also, not particularly, most interesting to me also in Europe and in the United States. And March and April showed high growth, 15, 16% growth in sales and profits in Europe over the same months last year, and in the United States over the same months last year. Now, where's that come from? I'm guessing, I can't be certain, but my assumption is, reading the announcement, you're sitting at home, you don't go to your coffee place, you now decide you might as well buy a nice coffee machine at home, or you're having to eat at home and feed the kids who are now not going to school, and sometimes you would get the kids some sort of a junky type food. Well, why don't you get a waffle maker or a jaffle maker or whatever? So Breville is in fact booming by people being stuck at home. Now, if the people stuck at home were all broke, they wouldn't be spending all this extra money on Breville equipment, which they clearly are. So that's the first one of them. The second one is one that I've now seen in all sorts of media, from American media to Australian media, and has been sent to me in emails by a number of members. And it's absolutely true. Unemployment is rising faster than the Great Depression. Now, that's really scary. When that sperm hits that egg in my brain, that says to me, wow, my dad used to talk about the Great Depression. He lived through it as a young man. And that was a very, very scary period. And because he lived through it and he was an adult at the time, he talked about it quite a lot. And he talked about having gone from having a really lovely job, buying himself some new clothes every now and then, living quite nicely. He went to the point where his shoes got holes in them and he used to have to put cardboard in the bottom of his shoes because he couldn't afford new shoes, that they used to eat bread and milk for a meal. They'd take a slice of bread or 2 slices of bread and dip them in milk because they couldn't afford butter to put on the bread, and they couldn't afford any meat or any fish. So that was their meal. But he was very pleased that he didn't drop to the point where he had to stand in the soup kitchen queues, but he was unemployed for a number of years. Now, when we hear unemployment rising faster than the Great Depression, I've tested this, by the way, on a number of friends. Now, my friends, I think, are all pretty intelligent people. They are, in my opinion, and all quite well read. And they're all probably round about my age. Some of them a few years older, some of them a few years younger. And every one of them, I said to them, describe to me what you think of when you think of the Great Depression. And the first things that everybody said to me were businesses going broke, people becoming unemployed, that's number two. And the third thing was standing in lines for soup kitchens. Now, why did unemployment rise much faster today? Sorry, just one sec. Rise much faster. Why is it rising much faster than in the Great Depression? Now, if we think about what most people were employed in the Great Depression, the vast majority of people in Australia, Europe, and mostly the United States were employed in factories. Factories had huge capital cost. You had to build this big factory or rent this big factory. You then spent what in today's money would be many, many millions of dollars on the equipment that went into the factory, and you had a vast number of people in it. The person who owned, or the company that owned, if it wasn't owned by an individual but was owned by a company, who owned that factory had put all of their money that they could possibly put, usually, into running that factory. Now, if sales from that factory dropped dramatically, as happens in any kind of recession, they were stuck. They had this huge capital cost. For many people who owned factories at the time, it was their only real asset other than their home, and their home was often mortgaged in order to provide the funds that were required to run the factory. They certainly weren't going to close down their factory. So everybody hung on and hung on and hung on and hung on as long as they possibly could, until probably in the end they went broke. Now, while they hung on and hung on and hung on, they didn't necessarily fire all their staff. They didn't get rid of all their employees, because they were hoping that this major asset that they had would be able to get going again. Now, most people are employed in services, by far, far, far more than they are in factories. So with most people employed in services, the capital intensity of most services business is peanuts compared to what it was in factories. So when you've got a business and your sales drop, you say, well, do I need all this staff? If you don't have a JobKeeper program like we've got in Australia, and you've got a similar situation to America, all you do is make your people unemployed. So hardly surprisingly, unemployment is rising faster than the Great Depression. But the flip side of that is it will also recover quicker, because in the Great Depression, if you owned a factory and you went broke, even if you now felt that the Great Depression was over and there was now a market for your products again, where were you going to get the equivalent of millions of dollars to build your factory again? You couldn't. Your machinery had all been sold off. The building had been shut down. Half of it had turned to broken windows and so on. It took millions to start a business. Today, most businesses are started with very, very little capital. I mean, many of them start in somebody's garage. It's mainly intellectual capacity that starts businesses today, not massive amounts of capital. Now, there are some exceptions, obviously, but most people are employed in businesses that are capital light, not capital heavy. So although unemployment is rising faster, so will employment rise faster, because the moment somebody wants to restart a business, they can restart it much quicker in most cases than they could in the Great Depression, where it was almost impossible. You couldn't borrow money from banks. So many of the banks had gone broke anyway, and it was almost impossible to restart. So when we think of it, we've got to say to ourselves, yes, even though unemployment is rising faster and may get to higher percentages than the Great Depression, it's estimated in the US that unemployment is a greater percentage of the population than there was unemployed during the height of the Great Depression. But many of them are going to get back into jobs very much faster than they would have got in the Great Depression. Now, that leads to the other one that analysts then say, and or rather I should say commentators then say, economic commentators, well, if unemployment's rising faster than the Great Depression, this economic downturn could be worse than the Great Depression. Now, it could become true, but it would take some extraordinarily large mistakes by all the people in positions where they can make those mistakes to make that true. if we look at the differences between now and the Great Depression, in the Great Depression, governments were sucking large amounts of money out of the economy. They believed the correct thing to do at the time was to draw money out of the economy to make sure that the budgets didn't go into deficit. Now, nearly all the governments around the world are pumping up their deficits, pouring money into the economy. That's quite the reverse. Secondly, in the Great Depression, what happened to a lot of people is banks went bankrupt. So any savings they had, if they were middle-class people and they had savings in a bank, their savings in a bank became worth zero when the bank went bankrupt. And thousands of banks went bankrupt in the United States, as an example. The unemployed had no social security. Today, the unemployed have social security. So somebody who's currently unemployed and is on a job seeker allowance, sure, they're not living wonderfully well, but they're not exactly starving and having to stand in soup kitchens. Their economic well-being hasn't been turned to the point where they cannot spend a single solitary cent because they don't have it. They have some money to spend, perhaps just not quite as much as they had before, although for some job seekers, in some cases, even more than they had before. And then lastly, and probably the most important to the whole lot, is at the time of the Great Depression, 1929 to mid-1930s or so, mid to late 1930s, 90% of the population prior to that period lived on what we call today level 1 or level 2. They lived in what we would today call, not what they called it in those days, what we would today call extreme poverty, which was level 1, or poverty, which we would call level 2. If they were on level 2 and they lost their job, it would only take a couple of months and they would be back on level 1 in extreme poverty. Today, only 58% of the world as a whole lives in level 1 and level 2, and virtually none of the population in Europe, Australia, or the United States. There's virtually nobody in Europe, the United States, or North America, I should really say, because I include Canada, or Australia and New Zealand, that lives on level 1. There are a few people living on level 2, but a tiny percentage. Worldwide, the percentage on level 1 and 2 is now 58%, not 90%. And if you're on level 3, which is what we consider not very well-off people in Australia or in the United States or in Canada or in Europe, people who really struggle, the battlers in Australia, they're level 3 people. It takes a lot for a level 3 person to fall all the way down to a level 1. So that effectively means, although the economic downturn in terms of percentage GDP contraction could be worse than the Great Depression, we've got to take out of our minds this picture we have of the Great Depression with people with only one set of clothes that was dirty because they couldn't afford to have them washed and they couldn't afford the soap powder, standing in queues waiting for some soup and some bread at the soup kitchen. It's totally different today. So we shouldn't invest like we think there's a Great Depression coming. But I've had a number of members phoning me and saying, this is going to be as bad as the Great Depression. No, the economic numbers may be as bad as the Great Depression, but what it does to the world is completely different to the Great Depression. You know, anybody who talks about in the good old days obviously didn't live in those good old days or has a false memory of those good old days. Now, another one that's come up obviously ever since 2 weeks ago, Buffett is holding lots of cash. Now, I can't tell you how many media articles I've read about that, but it's got to be at least 20, 25 by now, that Buffett is holding lots of cash. He's not buying. And the next statement that people often make is we should follow Buffett and hold cash and not buy. But here's the difference between us and Buffett. If I see a bargain on the stock exchange, seeing as I mentioned Breville Group earlier on, when Breville Group's share price dropped from over $20 a share down to $10 something. In fact, it hit $10, I think, during the day, but it didn't end the day at $10. When it halved, and I looked, and I already understand what Breville does, and I understand the business, I think, reasonably well, I looked at that and I said, but if people are stuck at home, they're going to buy more of this equipment, not less. This is a phenomenal opportunity for Breville. So I bought some Breville. Now, could Buffett do the same? No, he couldn't. If Buffett actually wanted to buy Breville and it to be even a teensy-weensy but significant in the $130 billion that he's got in cash, he would have to buy the entire business. And even if he bought the entire business, everybody would still be saying he's holding cash and he's not buying. Because even if he bought the entire business of Breville and the entire business of Credit Corp and the entire business of Accent Group and any of the others that I invested in, it wouldn't even make a dent in his cash flow because that much cash comes in every month that it would take him to spend on those. So what Buffett is looking for, as he often talks about, is elephants. He's looking for things that are many billions of dollars at a time. If it's not at least $5 billion, it's not worth investing. Now, in my case, I put about $50,000 roughly. It was between about 40 and 60 in about 5 different companies, each of which have now doubled or one is up about 80%. The others have at least doubled in price. Now, I'm not selling them, so I haven't actually yet made a profit, but their paper value is considerably more than when I bought them. So it's been a good investment so far. But the total amount that we're talking about on any one of the individual companies, if we call it $50,000, Buffett's got to invest $5 billion to be making the same dent in his cash, roughly, as I would be making in my cash. And those kind of opportunities don't come up very often. The bigger the company, the more it's understood. The smaller the company, the less likely it's to be understood. So if Buffett is looking for $5 billion investments, it's highly unlikely he's going to get those because the market misunderstood the company. If I'm looking for a $50,000 investment, it's very likely indeed that the market's going to misunderstand several of the companies that I want to invest in, and I'm going to get the opportunity to invest in them. What Buffett has got to wait for is not a misunderstanding when he's got $5 billion at a time to invest. What he's got to wait for is some company being in trouble where he can do a structured deal, much like he did in the GFC. Now, when he had 100th of the money that he's got today, he wasn't dependent on that. But with the kind of money he's got today, and we've got much less than 100th, with the kind of money he's got today, he's not going to get mistakes being made by the market misunderstanding the company. By the way, with Breville, that the market clearly misunderstood, it didn't take long. It's only taken them about 3 weeks, 4 weeks, and they started understanding the company better, and the share price headed up towards $20 again. So we only got the opportunity to buy it that cheaply for a couple of days, but we at least got it. Buffett's not going to get 5 billion opportunities like that. And the last point about it is, if we read a number of different years worth of Buffett's comments, not just the one time which coincided with COVID, and hence we were focusing on COVID rather than thinking more widely. By the way, when I say we, I'm including me. I make these same mistakes all the time. I was watching Buffett's talk and realized he was holding so much cash. And I thought, geez, why is the guy not buying? My immediate reaction was, he thinks it's going to get worse with COVID. When I thought about it an hour or two later, I came to this conclusion of the extra cash. Then I also thought, in other words, that he needs to invest billions. Then I also thought a little bit more deeply as well. And I thought, well, hang on a minute. Why has Buffett always in recent years been holding too much cash? Too much cash being in inverted commas, that the media and the commentators keep saying he's holding too much cash. Well, one of the big ways that Berkshire makes money is insuring things that nobody else wants to insure, where the premium is giant, and the only people that will take it is Berkshire, and more important from the client's point of view, which when it's an insurance company taking out reinsurance with one of Buffett's companies, the most important thing when you're taking out reinsurance is you want to know that the company you're taking the reinsurance with has got pockets deep enough that they can pay out if you need the payout. So when somebody takes reinsurance payout premium with Berkshire or one of the Berkshire companies for, say, a earthquake in California or a hurricane off the coast of Florida, they want to know that the insurance company is going to have the cash to pay them out. So from Buffett's point of view, by holding what appears to be excess cash is part of his marketing story, because people will bring him the $5 billion premium or the $3 billion premium or the $6 billion premium that he's going to make a lot of money on investing in the interim, rather than giving it to somebody else, because they know if they give that premium to Buffett, they will get a payout. So I forget who it was, but some company insured in the GFC with Berkshire Hathaway for some extraordinarily large premium. Somebody's bound to remember it and put it on the chat thing, that the S&P 500 would be above a particular figure in so many years' time or whatever. They took out portfolio insurance on their huge managed fund and all their investments. And effectively, it was free money. Buffett got the money for nothing. He knew he was never going to have to pay out. The chances of him paying out was so infinitesimally small. But why did they come to Buffett? He had the money. So because Buffett's not buying teaches us nothing about whether we should be buying or not buying. It would only teach us something if there's any one of us who is looking to deploy, even if not the size money that Buffett's deploying, if any one of us was looking to deploy 50 million or 100 million at a time in individual companies, maybe we should be looking more at what Buffett is doing. But when we're looking to deploy 50,000 or a couple of 100,000 in each individual company each time we buy, or maybe only 25,000 each time we buy, looking at what Buffett is doing is not the relevant thing. We should be thinking like Buffett, not investing like Buffett, because he can't invest like us, the same as we can't invest like him. Nobody's going to come to me with a structured deal where I can take a warrant for $5 billion over their company at an 8.75% interest rate, and that I can convert them into shares someday in the future. Nobody's going to come and ask Howard Coleman to do that. But by the same token, Buffett can't invest in Breville Group or Accent Group or Credit Corp when they got incredibly cheap, or whichever it is that's going to get in. It may not be the same companies anymore, whichever it is that gets incredibly cheap in the second half of May and in June, when somehow or other the market has a panic about the whole market or about that sector or about those companies. But I can invest in those. We all can invest in those as Teaminvest members. Now, the next one to talk about is that, and this I've seen in various forms, so I had to make my own sentence out of it. All the others, I just copied the sentence from what was in the media. Sales plunge in a deep recession, prices plunge in a deep recession, margins plunge in a deep recession, profits plunge in a deep recession. They didn't all say plunge, they would say drop, they would say get smashed. But all of those things have been said happen in a deep recession. And when somebody talks about the economy overall, for the economy overall, that may well be true. And it may be true for many companies in the Great Depression. But let's have a look at it logically. The Great Depression was caused by a shortage of demand. People didn't want to spend money. There was a shortage of demand. This recession has not been caused by a shortage of demand in most industries. It's been caused by the economy being shut down in order to save lives. Now, it's not that cafes and restaurants have no clients because nobody wants to go to a cafe or restaurant. Cafes and restaurants have no clients because they were shut. It's not that the pubs can't sell any beer because nobody has any money to buy the beer. It's that the pub can't sell any beer because it's closed, etc., etc. So let's just take cafes and restaurants, seeing as it's a business. Let's just stick to restaurants, seeing as it's a business we all understand. We've all eaten in plenty of restaurants. We know what it's all about. We've been to many different ones. With what's happening with the shutdown now, a very, very large number of restaurants, I'm pretty sure, will go broke and they won't reopen. That means, I don't know what percentage of them, I don't know what number it's going to be, but there's going to be lots of them that don't reopen. Because they don't reopen, the supply of spaces in a restaurant is going to shrink dramatically. On top of that, social distancing means that the number of bums that are allowed to be on a seat in a restaurant is going to be restricted for a long time. At the moment, it's to 10 in most states. Maybe it'll get more than that for big restaurants, but it's pretty small. Now, if you're running a restaurant and you know that many, many more people want to come and eat in a restaurant than you can seat in your restaurant because you're only allowed to seat 10, and lots of your competitors have gone broken, whereas they could have gone up and down the street and there were 30 in this particular street, and now there's only 20 in this particular street because 10 have gone broke, and each one's got a queue outside because people can't get in. What would be the smartest thing you could possibly do? Put your price up. You can only seat 10 people anyway. You might as well put your prices up 10% or 20%. Have a couple of people look at the menu and say, oh, too expensive, and walk away, and you only seat the ones who don't mind. So therefore, sales may drop, prices may rise, margins may rise, and profits may rise for that particular restaurant. For other businesses like Breville, we've just seen that sales have risen. Interestingly, they mentioned that their margins had gone up slightly as well. It was only a very small amount that their margins had gone up. And I looked at it and thought to myself, wow, that's only in the first 6 weeks of the shutdown, or 8 weeks in the case of some countries of the shutdown. They're pretty smart management. I wouldn't be surprised we'll see their margins creeping up. You know, it's not going to suddenly rocket, but creeping up a little bit. And if their sales are up and their margins are up because their prices are up, their profits are going to be not plunging, but rocketing in this deep recession. Now, I gave the example of restaurants simply because restaurants are a business we all understand. But the same thing applies in pretty much any business. If a lot of your competitors are going broke, therefore the supply is being reduced, you don't necessarily have a shortage of sales. There's a shortage of sales in the industry. That particular industry is now smaller than it was before. The total sales volume is lower. But the individual companies within that industry may in fact have increased sales. If it's being caused not by a shortage of demand, but by a shortage of being able to supply because of the lockdown, well, that's a perfect reason to put up prices, put up margins, and put up profits. Now, when we're thinking as investors, the same thing applies. Act like sales, prices, margins, and profits for every company we've invested in are going to plunge. We're going to do dumb things like put 20% in the margin, in our required rate of return on conscious investor, and exclude ourselves from investing in things where we're going to get spectacular returns, or we're going to reduce the expected growth rate, or we're going to reduce the earnings per share without thinking through, will this company actually have those things happen? Or what we're thinking about the whole industry, and seeing as we're not investing in the industry, we're investing in the companies, and their competitors may cease, their sales, prices, margins, and profits may in fact rise rather than fall. Tied in with that, by the way, is that in the Great Depression, prices fell overall. There was the opposite of inflation, there was deflation. But there's no reason to think that that's going to be the same here. That was caused by the actions of government in reducing the monetary supply, banks going broke, and at the same time, there being a big reduction in demand. This time around, we've got a lockdown creating a reduction in supply in many things and tons of money being pumped into the economy. Now, the next one here doesn't necessarily apply to businesses, but the market. The market could drop below the levels of March the 23rd. Absolutely. That's definitely true. The market could also rise above levels of who knows what. Markets do funny things. They go up and down in the short term, but in the long term, they're usually a reasonably accurate reflection of the society and the economy in the country. But in the short term, they do all sorts of funny things. All we need is some, I don't know, in the United States, suddenly death rates to rise from the, whatever it is, 1,000 a day, or whatever they're having dying at the moment, to 5,000 a day. And suddenly they decide to do lockdowns again, or Europe does lockdowns again, and stock markets could drop. However, when a stock market drops, it doesn't necessarily mean that every company on the market is going to be losing money. So some of those that drop will be bargains. Some of those that drop will be going broke. Now, if the share price of Myer drops below the price it was on March the 23rd, I don't follow Myer, so I don't know what it was on March the 23rd. My guess is some cents. It certainly wasn't over $1. Whatever the price was on March the 23rd, however few cents it was, could it drop below that figure? Sure, it could drop to zero one day. The same as JC Penney, Neiman Marcus, and other department stores in the United States have gone into administration and could go broke. Badly run businesses in Australia are going to go broke. Now, if they form part of the market, Myer can't form a significant part of the market. But if companies form a significant part of the market could drop dramatically. I wouldn't want to buy those, even if, I wouldn't buy Myer if it dropped to 1 cent. On the other hand, if a company that we really like T&E, drops below whatever it reached on March the 23rd, I wasn't following it at the time. I owned lots of T&E. I was looking at some other companies at the time. But if it dropped to a figure that got attractive and the Stret D looked good, and it was below my target price without putting funny numbers like 20% in the margin of safety, then I would be only too happy to buy it. Now, that brings back the slide that I had in one of my previous presentations. I've marginally changed the first 2 lines in it because I've added in true. Markets may take years to recover. True, it could take a decade or more. May even take 2 decades. There have been a couple of times in history when it's taken stock markets to a whole decade to reach the number they were at before. But it's got no real relevance to us unless we own an index fund. The only time it would be relevant to us is if we owned an index fund or we ran an index fund. And just as a reminder, and I covered this some time ago, in 2007, before the GFC, the index topped 6,800. 13 years later, it's now around 5,500. I think it was actually 5,400 today, but lower by about 19 or 20%. The reason is what it's most heavily weighted to: the banks, the resource companies, insurance companies, property. Only CSL, it's a significant part and was a significant part in 2007 of the index. It's a more significant part today than it was then. That would be a company we'd be ever looking at. Only 2 of them in 2007 passed Conscious Investor. I don't think any of them passed Conscious Investor at the moment. CSL's got too much debt. And I think every other company in the top 30 doesn't pass CI, but I may be wrong. I may be missing one. There may be one company in the top 30 that currently passes CI. But if we, again, just as a reminder, if we look at an accumulation index on Conscious Investor, if we assumed a base of 6,800 on December the 31st, 2007, that would now be over 38,000. And we covered that once before. Keith, it may be an idea now for you to come in and just give me any of the comments on the first half, roughly. It's a bit over half, actually, of the slides that we've done. Is there anything, really valuable comments that we should have there?
And well, it's been shared with everyone, Howard, but there was a comment from June. You were talking about restaurants have 20% of clients, so they need to put their prices up accordingly. That's absolutely true. And also, in regards to Breville, Lionel said of a friend whose business is selling Breville products to Korea, where they're seen as a premium product. It was cheaper for him to buy directly from Harvey Norman initially, as Breville put their prices up. So just some quick comments there. Thanks,
that's interesting. And funnily enough, the previous CEO before the current CEO of Breville is actually a member of Teaminvest. So you can have a chat with him one day, any of you who want to. He's a Sydney member and really lovely bloke. Have a chat with him. Any others there, Keith?
No, that's all good.
Okay, so moving on to a couple of others. One that's been running, not so much in our media here, but it's been running around the world, is it's now the deepest recession in the history of the European Union. Seeing as I always thought a recession was 2 quarters of negative growth, I'm not entirely sure that that statement is correct, but let's assume it's true, because even if it isn't yet true, we would assume at the end of June or just after the end of June, when they report on that quarter, that's going to be a recession quarter anyway. So if it wasn't the 2 quarters already, it will be 2 quarters soon. Now, I think this is quite a cute one, because the media ran these big headlines: deepest recession in the history of the European Union. And my first reaction was, geez, Europe's having its deepest recession ever, worse than the Napoleonic Wars. That's terrible, can't possibly be right. And then I saw, wait a minute, history of the European Union. Well, that's not a very long history. So the fact that it's the deepest recession, if it's true, in the history of the European Union, isn't telling us an awful amount. Now, the other thing, besides it only having a short history, is from an Australian perspective, I would doubt that more than a maximum a handful of our members would have any direct investment in companies in the European Union. We may be invested in companies in Australia that do some business in the European Union, and we probably, most of us, would have at some stage been invested in perhaps 1 or 2 or 3 US companies. But I've never had anybody talk to me, maybe they just haven't spoken to me and perhaps they are invested, about being invested in companies that are specifically European. Little of our trade is with the European Union, and little of our new money invested in Australia comes from the European Union. When I arrived here 30 years ago, the US and Europe were by far the biggest trading partners with Australia. They were where all our money came from, our capital came from, and they were our biggest trading partners. Now, it's only 30 years ago, but today it's now Asia is number 1 and Asia is number 2. We don't really trade much with the European Union at all. And interestingly, with all these previous ones about our terrible recessions, our March trade surplus came in at $10.6 billion. Now, trade surplus means, other than the current account, but our current account's been doing quite well recently too, that a trade surplus of $10.6 billion means other people bought $10.6 billion more of stuff from us than we bought from them. Now, that means that the others who are buying the stuff from us must have had money, because otherwise they couldn't have bought it from us. Now, if it wasn't the Europeans, where did most of it come from? Most of it came from Asia. The biggest single proportion of that came from China, buying iron ore and coal. And hopefully that continues, although with the rhetoric going between us and China and us and the United States and China, I do worry that that may not always continue, and we're not the only potential supplier of iron ore. The Chinese are busy developing West African iron ore. That'll still take them a few years to get it to the level that we can supply. But there's plenty of iron ore and plenty of coal in China. It would be more expensive for them to use their own rather than buy from us. But hopefully it doesn't get to that point. Now, here's another one. tourism income and education income has collapsed. Now, I've amended that to say income from inbound tourism and education has collapsed. And that's really true. I'm on the board of a college at a university, and I know that the number of students from overseas attending universities in Australia has absolutely collapsed. That brings a lot of money into our country that's now not coming. Also, inbound tourists aren't coming, hardly surprisingly. We've closed our borders, and quite correctly, we've closed our borders probably. So yes, all this money isn't coming in. However, there's two sides to tourism. Whenever I've travelled overseas, and I've done a fair bit of it over the years, I'm always amazed how many Australians there are. You would actually think there were a couple of 100 million Australians, because wherever you go, there are other Australians in the same plane as you, even if you're not flying from Australia at the time you're flying between two cities in Europe or America. There are other Australians in the hotel with you. There are other Australians on the train with you. There are other Australians in the museum with you, in the art gallery with you. You keep hearing Australians all over the place. So yes, it's true that inbound tourism is not generating revenue for us, but then outbound tourism isn't taking our money overseas. And we would be spending that money here in this country instead of overseas. And if we can't go overseas on holiday, those of us who can generally afford to, and that's pretty much most of the population of Australia does get to go overseas at some point in their lives, all that money, if it can't go overseas, will get spent here. Now, I'm not saying it's an equal amount. I'm sure that the country earns more in inbound tourism and education than we spend in outgoing tourism, but we spend a hell of a lot in outgoing tourism. So we shouldn't just look at this one number. And the reason, by the way, I didn't put a number on the slide is I saw several different numbers and I didn't know which one was right. But there were several different numbers in many billions quoted in different articles about how much this collapse in inbound tourism was going to cost Australia, and in education was going to cost Australia, but they didn't subtract the amount going out. So on its own, again, if we make a decision based on that, it's a decision with too little information to be an intelligent decision. Now, in the end, though, we do want markets to drop. So the fact that all of these statements that I've gone through are true but incomplete, it's rather handy for us that they're true, because being true, I suppose it would even help us if they were untrue and believed, but let's not want things to be untrue. If they cause a drop in the stock market, we get to buy at prices that offer us a high street D. Now, the thing with a high street D, though, is you want to be realistic. There's been a lot of talk recently. I've had many phone calls and emails about it. Should I set my street D at 20%? Well, there's a problem with that. If you're going to set your street D at 20% and put that into your required rate of return at 20%, because you don't want to buy unless there's a street D of 20% and you put your required rate of return at 20%, what you're really saying is, I want my fellow Teaminvest members to be really stupid, and I want everybody else who's on the market to be stupid, and I want all fund managers to be stupid, because I can only get 1.5% or so in the bank. I'm going to set a street D of 20%, and I'm going to assume that everybody else is so stupid that they don't buy when it gets to 15 or 16 or 17 or 18 or 19 on the margin of safety. Now, if it's a tiny, weeny little company that you know extremely well, and it passes conscious investor, but we've never covered it in a triage, it's never passed a triage and we've never covered it in a smart, and therefore you think none of your fellow Teaminvest members are watching it as well, you may get away with it. If it's a big company, you've got no chance getting away with it, because all the big fund managers that have got millions would be investing in it long before a margin of safety street D got to 20%. Now, they may not have conscious investor, but I'm sure they've got people with PhDs in mathematics who can do some calculations and can work out that even on their strange methods of valuation, that it's a terrific bargain. But if it's a company that passes our filters and it's passed a smart, you'd have to assume all the other members of Teaminvest are that stupid that they're not going to buy it before it gets to 20% for you to get it to 20%. Now, I think our members are generally pretty intelligent, and I think our members generally use CR pretty well. Now, obviously, newer members don't necessarily know how to use it as well as the more experienced members, and Keith and John have been running webinars on that, which I recommend to everybody. If you haven't watched them, watch them. But it's, in my opinion, unbelievable optimism to think that you're going to get something at a stretch of 20%. You may occasionally, I think Credit Corp got to the point that the stretch D was significantly more than 20%. So if I'd had a required rate of return of 20% in it, I could have got it. But pretty much everything else that I've done extraordinarily well out of in the last month or two, I would never have got it if I put a required rate of return of 20%, because my fellow Teaminvest members would have perhaps put 19 or 18 or 17 and each spent their $50,000. And on the companies that size would probably have moved the price. And some fund manager must be watching the company, unless it's minuscule, and would also look at it and say, hang on, look at that amazing bargain. Let's put 10 million in. So when you look at the required rate of return, my viewpoint is, now obviously you can disagree, you can put whatever you like, but my viewpoint is that under a margin of safety, and generally the companies tend to do about 1.5 times as well as the margin of safety, on a margin of safety, if you're going to put an amount higher than about 12% for the margin of safety, which means 18% probably is what you're going to get, I think you're being extraordinarily optimistic in hoping that you're going to get it at that price that you're going to require there. You may get a very occasional one, but very, very few indeed. And if you think you need, from a risk point of view, an amount as high as 20%, my recommendation is don't buy the company at all. Because if you think the company is that risky, that if you could only get 1.5% in the bank and you'd want 20% from this company before you moved it from the bank into this company, then to me, you're saying this company is so dangerous, the risks are so high that it's a total and utter speculation. It's not an investment at all. And I'm really completely speculating that this company will survive, but I don't really believe it will. So I think that's a little bit of a worry, but certainly we do want markets to drop. So when you're talking to your friends, neighbors, etc., or actually if it's your friends, no, stick with the truth with them. But if you're talking to people who you don't particularly like and they say to you, oh, I'm sure the market's going to drop a lot, I wouldn't buy anything now, the best thing to say is, I agree with you. I was up at the shops last week just getting some groceries, and somebody recognized me and said, oh, are you the guy who's always on TV? And I said, sometimes. And he said, yeah, I think the market's going to drop like crazy. We haven't seen the bottom. This could get down to 2,000 points on the ASX, and I'm not buying a thing until it gets there. And I said, great idea. And I paid for my groceries and left. I didn't particularly feel I needed to help him. So lastly, in summary, and then we'll wrap it up, which will make it just over an hour, hopefully. Our brains are developed to save our lives. They're wired to react fast to the first stimulus. As we've joked so often in Teaminvest meetings, if our ancestors' brains hadn't been wired that way, they wouldn't have passed on their genes and we wouldn't have existed in the first place. So it's not wrong that our brains are developed in that way and to react fast to the first stimulus. It's probably saved my life driving a car a few times. It's probably saved my life a few other times, or at least saved me from getting hurt, if not getting killed. Certainly in playing cricket, it saved me getting hits on the head in the days when you didn't have helmets. because as soon as I saw the bowler looking that fierce and slamming the ball in, I just ducked. So our brains are developed to save our lives and are wired to react fast to the first stimulus. We don't want to change that. However, as investors, we need to look wider and deeper than that first stimulus. We need to decide rationally, not just from the first factual stimulus. And one of the things that I do is I say to myself what this next thing is, I'm never going to have complete facts. I know for sure that when I'm looking at the future, my facts will never be complete and accurate. But when I get that instinct, as I get, oh, hell, what's wrong with that company? Look, it's just dropped 10%. Or, geez, the market's down 500 points. I better make sure I've got lots of cash. Or I better get out and convert everything into cash. I know that that's the first stimulus. I know what it's doing to me. So the next thing is I say to myself, what else should I consider? Now, you may be better at this than me, but when I say to myself, what else should I consider, I find it very difficult to come to an answer. The best thing I can possibly do is take a pause, go for a walk for 10 minutes, or when it was summer, go and have a swim in my pool for 10 minutes, run up and down the stairs that are next door my house, which goes about 5 levels, and then come and sit down again and think about it. Because 10, 15 minutes later, I can often think, sometimes only an hour later, I can often think of another fact that's got something to do with it that is really important. And then I say to myself, well, I've got 2. How many more can I consider? By the time you get to 3 or 4, you're probably getting to the point that you're looking at it at least properly enough to make a decision. If all you're doing is taking your one fact and then building all your decision-making processes on top of that fact and rationalizing everything you do on top of that one fact, almost certainly it's a sperm and egg and you're going to run yourself into trouble. Now, what I see a lot of members doing is once they've got their one fact, not only do they build all their decision-making on that fact, they then build a whole mathematical calculation on top of the one fact. Now, I'm sure the maths is right, by the way. I'm not for a moment suggesting it's incorrect mathematics. But the very, very last thing you should do is looking at the maths. Until you've said, what else should I consider? And you've come up with 3, 4, or 5 facts that are in contradiction to or balancing out against that first stimulus, that are telling you things different to that first stimulus, you're not ready to model it. When you've got all the things that you can think of that are telling you things different to the first stimulus, then modeling may be a good idea and put together some numbers to work it out, starting on a conscious investor. And if you want to have some fun further than just conscious investor, I really go beyond putting it in conscious investor, despite having majored in mathematics at university and done 3 years of it. I still don't. And then lastly, just remind yourself, and this is the thing that stops me modeling it, because otherwise I'm really can have great fun with spreadsheets. I keep reminding myself that modeling based on incomplete facts or guesswork is likely to be inferior than to polling chimpanzees. Now, the polling chimpanzees is a new bit. I always used to say is likely to be inferior than just having a guess to start with. But having read the book by Hans Rosling, Factfulness, which I strongly recommend to all of you, great book. Hans Rosling polls people in all more than a dozen countries in the world, all the developed countries, what we generally call developed countries, on a number of statements with 3 possible answers. And if you chimpanzees, in other words, they randomly guessed any one of the 3 answers, the chimps do better than the humans. And the more educated the humans, the worse they do. And he went to Davos. It's in the book. If you've read the book, you've heard the story. He went to Davos, to the World Economic Forum, and he gave them the same questions. All the experts at Davos, being quite embarrassed because he was pretty sure if he polled the people at Davos, nearly all of them would get it right. After all, the top people from all around the world who are making recommendations to government on how to run their countries, recommendations to businesses on how to run their businesses. Pretty sure this group will be different. They will poll extraordinarily highly. And much to his amazement and relief, because he didn't want to look like a fool when they all got the questions right, and then asked him, why is he asking such stupid questions? The people in Davos, in general, polled all of the questions worse than the chimpanzees. So these are the experts that are quoted on television, quoted in the newspaper, and who we normally hear and think, well, if he says it, it must be right. And on average, they polled worse than a random selection by chimpanzees. Now, I'm not saying I'm any better. All I'm saying is we all know when we get given a statement, if it sounds factually correct, we react to that first stimulus and we don't think it through. So the key thing is to ask yourself, what should I consider?